Hey guys, I'm one of the few who has been saying for the last 3 years that there will not be a housing crash. I took some time, 4 months, for this video because I wanted to show real, honest perspective. For several years, we've been warned, it seems daily, about a housing crash. It's been the dominant story in real estate news and has included variations like crash, crisis, or other scary words in all capitals. Did it happen and I missed it? Is it coming? Let's look at some of those headlines. Here's one. These four cities will suffer a 2008 crash in home values. Goldman Sachs, as interest rates continue to skyrocket, home prices across the country have continued to plummet. And Goldman Sachs says the declines will only worsen and extend through 2023. Goldman Sachs forecasted that 4 American cities in particular should gear up for a seismic decline compared to the 2008 housing crash. Oh my gosh. San Jose, California, Austin, Texas, Phoenix, Arizona, and San Diego, California will likely see boom to bust declines of more than 25%. Such declines would rival those seen around 15 years ago during the Great Recession. Home prices across the United States at that time fell around 25 to 60%. Here's another. 4 in 10 consumers expect housing market will crash, survey finds. Of those expecting a crash, 3 out of 4 think it will be bad or worse than the 2008 housing market crash. National home prices have further to fall, say 24 leading housing market researchers, while 5 firms think prices have bottomed. Bank of America, the investment bank, expects U.S. home prices to decline by around 10% peak to trough. We expect a home price correction down 10% rather than a crash down 15 to 20%, wrote researchers at B of A in their January 11th report. ING peak to trough, the Dutch bank tells Fortune it expects U.S. home prices to fall between 5 and 10%. However, the multinational lender says U.S. home prices could possibly decline by as much as 20%. Morgan Stanley, the Wall Street bank, expects home prices to fall by around 10% between June 2022 and bottom of 2024, with experts warning of a potential 15 to 20% plunge in prices. KPMG, the Big Four accounting firm, expects U.S. home prices, as measured by the Case-Shiller Home Price Index, to fall 20% between fourth quarter 2022 and fourth quarter 2023. A similar headline, Zillow says home price correction is winding down, and here's what 28 other forecast models have to say. Almost every month for the past year, Zillow has revised its 12-month home price outlook downward. That finally changed this last spring. Elon Musk warns house prices are set to plunge and says commercial real estate is in meltdown. Commercial real estate is melting down fast and home values are next. Well, he's the expert. He's the Tesla and SpaceX chief tweeted. Then, when they started to see that they were all wrong, they started to change their positions. Look at these. 2023 year-end home price forecasts. They went from negative 15 to 20% to all positive gains. The housing market is near an inflection point. Home prices show signs of trending sharply higher, Black Knight says. The latest Black Knight Home Price Index rose for a seasonally adjusted monthly rate of 0.7% in May, hitting a new record high. The 5th consecutive monthly gain also completed a full reversal of the retreat that began last July. That's July 2022. They said in a statement that the annual rate would remain at or near 0% for only a short time before inflecting and trending sharply higher in coming months. He added that the reheating of the housing market is widespread, with 27 of the 50 largest markets at or above their prior home price peaks. Now that they realize that they were all wrong about a crash, the headlines in media you'll see will stay negative, referencing affordability. This October, Forbes wrote, Housing market predictions. When will home prices be affordable again? Housing market activity already cooling due to eye-popping home prices and interest rates may be on the verge of a deep freeze. Nonetheless, the housing market remains competitive for prospective buyers, with many homeowners locked in at low interest rates and unwilling to sell. Demand continues to exceed for sale inventory. Housing stock remains at near historic lows, especially entry-level supply, consequently propping up demand and sustaining ultra high home prices. To make matters worse, new home construction, which had been helping pick up some of the slack, receded this year. Inventory is approximately 46% below the historical average dating back to 1999. Starter home costs are on an upward trajectory that has put homeownership further out of reach for those already constricted by limited down payment, savings, and incomes that cannot keep pace with costlier monthly payments. For example, first-time home buyers hoping to buy a starter home will need to earn about $64,500 a year. That's 13% more than just a year ago. A typical starter home hit an all-time high of $243,000 this last June. They ask, will the housing market crash in 2023? National home prices rose at an annual rate of 1%, according to the latest S&P CoreLogic Case-Shiller Home Price Index, a leading monthly tracker of U.S. home values. U.S. home prices continued to rally in July of 2023. On a year-to-date basis, the national composite has risen 5.3%, which is well above the median full calendar year increase in more than 35 years of data. One of the factors affecting inventory is highlighted in this article. Coldwell Banker uncovers why international buyers dream of owning U.S. real estate. Affluent international buyers are dreaming big, spurred by location and lifestyle preferences, and overall positive outlook on the U.S. luxury real estate market and more. In fact, a significant number of respondents say they are optimistic about the state of U.S. real estate, the U.S. real estate market. 80% of luxury consumers believe purchasing real estate in the United States is a safe investment, and 76% rate the current market conditions to purchase home as excellent or good. The survey, conducted in partnership with Census-Wide, highlights the consumer sentiments of over 1,200 high net worth consumers from 12 countries. The findings serve to unpack the dreams, desires, and attitudes of international luxury home buyers, offering insight into what's driving their interest in U.S. real estate, where they're dreaming of moving to, and the factors impacting those relocation purchases. International investors are willing to bet on U.S. real estate. Traditionally seen as a hedge against inflation, real estate may provide financial, emotional, and psychological stability, especially in the face of uncertain market conditions. International wealthy consumers seek to diversify their real estate portfolios, build generational wealth, and make opportunistic buys in luxury markets. Their survey also reveals virtually all 97% respondents from Mexico consider purchasing real estate in the United States as a safe investment, ranking them the most likely country surveyed to do so. Participants from Spain and the United Arab Emirates did not fall far behind, with 92% saying the U.S. real estate is a safe investment. The media doesn't promote articles like this next one. House flipping profits continue to rebound as home prices soar. Surging U.S. home prices this year have pushed profits up for house flippers in the second quarter. Gross profit on a typical house flip increased to $66,500 in the second quarter, up 18% from $56,000 in the first quarter. That translated to a 27.5% return on investment. The rebound came as the median price for a single-family home spiked 10% during the spring buying season. High demand and low inventory in the housing market have helped drive residential prices up this year. Finally, here's an insight that I agree with. House prices won't fall and could soar 15% when mortgage rates drop, says Shark Tank investor Barbara Corcoran. I can tell you this, house prices are not coming down, the Shark Tank investor and real estate tycoon told Good Morning America in August. All hell's gonna break loose once the Fed cuts rates and mortgages get cheaper. And look who made a total 180 turn. Zillow recently reported is a full-blown housing market bull, predicting the U.S. home prices will jump 6.5% by July 2024. Their forecast predicts that 120 of the nation's 400 largest housing markets will see increases of 7% or greater over the next 12 months. And just as I predicted last year, townhomes and condos reach all-time high price in Southern Nevada. This last September, prices reached a record high of $287,000, according to Las Vegas Realtors. As they said, the demand is higher for these lower priced options, and the supply is tight. Buyers can afford a little less, so they're buying smaller homes and in more cases. So what does this all mean? Fortune reports the $300,000 starter home is disappearing. A tenant society, not by choice, but by force. Housing prices drove up nationally, rising up to 41% during the pandemic housing boom. Fast forward to today, and mortgage rates are up and prices are still. So what does this mean for housing affordability? It means bad things. Unfortunately, I kind of laugh, but it's good and bad, good for some, bad for others. From Texas to California, Colorado to Ohio, they're disappearing everywhere. For example, San Antonio experienced a 12% decline in the share of projects under $300,000 this year from February 2019 in the same month, while Houston experienced a 16% decline, Cincinnati 29% decline, and the share of projects under $300,000 is none, coming in at 0% for the markets of Riverside and San Bernardino, Denver, and Sacramento, down from 3%, 4%, and 2%, respectively, in 2019. By 2021, according to the Census Bureau, the actual median household income in the U.S. is $70,784, while according to Zillow, the median home value in the U.S. by the end of 2021 is $297,000, more than 4 times the median household income. The share of projects priced under $300,000 is declining. So is affordability, simply put. Ali Wolf said, who's the chief economist of Zonda, and she says that worries her. We are unconsciously creating a renter society, not by choice, but by force. Why they are disappearing, Wolf said, is a complex answer related to factors including cost of building materials, availability of land, cost of labor, lack of housing supply, regulation, and zoning. Here are the 5 important factors affecting home prices that most just don't hear about, at least not altogether. A high majority of homeowners are not and will not need to sell their home, much less default. About 2/3 of primary mortgages, most of which are 30-year fixed rate loans, have an interest rate below 4%. According to CoreLogic, U.S. homeowners had $270,000 more equity on average by the end of 2022 than they did at the start of the pandemic. Business Insider reports U.S. homeowners are sitting on $28.7 trillion, that's trillion with a T, of equity. Homeowners have more equity in their homes today than they did at any point in the 35 years between 1987 and 2022. Almost 40% of homeowners have their houses completely paid off. And that's more than the proportion of people who rent in this country, which is around 1/3. And when you combine that with the fact that nearly 30% of homeowners have at least 50% equity in their homes, we're talking close to 70% of households who have more equity than debt in their houses. This is just a staggering number that never gets brought up when it comes to the state of consumer finances. Homeowners are richer and in better financial shape than ever when it comes to the biggest asset for most people. Another factor that just isn't reported much, institutional buyers won't stay on the housing market sideline forever. This is temporary. The pandemic housing boom was simply too good of a deal for investors to pass up on. Historically low interest rates, easy access to capital, soaring rents, and skyrocketing house prices. That's why everyone from mom and pop landlords, Airbnb hosts, to institutional big dogs piled in at the height of the pandemic housing demand boom. Invitation Homes, which owns 82,837 U.S. single-family homes, was a net buyer of 1,500 homes in Q3 2021, while American Homes for Rent, which owns almost 59,000 U.S. single-family homes, was a net buyer of almost 1,300 homes in the same quarter. However, that investor frenzy, which started in the summer of 2020, abated once interest rates began to spike in spring 2022. The combination of spiked interest rates coupled with a lack of homes coming for sale in 2023 has translated something of an institutional home buying freeze. Recently, though, MetLife Single Family Rental Fund revealed that it secured $390 million in committed capital. Additionally, in July, JP Morgan Asset Management announced its intention to engage in a $625 million joint venture with Americans Home for Rent, with plans to develop rental homes nationwide. Further, Invitation Homes acquired a portfolio of nearly 1,900 homes for approximately $650 million on this past July. They've been strategically buying portfolios and jumped into the build-to-rent space. I remember a few years ago, Invitation Homes had no interest in build-to-rent. There has been a lot of speculation from YouTube content providers, those weirdos, who believe the large investors will dump rental homes to get out of the trade, which is ridiculous. That has been debunked many times. Cheaper debt for BTR, and they can create their own supply. Also, the large multifamily operators can wrap their heads around build-to-rent and come into the space in a big way. The housing finance system is stacked, unfortunately, against the consumers. And don't expect any type of recession that will affect housing. People have money, and employment is strong. Here in Las Vegas, gaming revenue from January through August was almost $9 billion. Commercial and industrial occupancy rates for the third quarter was almost 96%. Over the past 12 months, total employment in Southern Nevada increased by 48,600, a 4.5% increase. Now check this out. Nevada casinos hit 1.27 billion gaming win in September. That's an increase of almost 2% compared to the same month last year, when the win revenue was nearly 1.25 billion, and up from the gaming win of 1.2 billion reported the month prior in August. It's also the 31st straight month that casinos in Nevada collected at least $1 billion in gaming win. Despite all of the misinformation we see in the news, people have extra money to spend. And I predicted over a year ago at the bottom of the market in the last few years, when almost everyone was predicting a housing price crash, that prices would be higher than they were at that time. And median home price nationwide hit a new high of $350,000 just last month. Keeping Current Matters highlights here how home prices have grown over time. My analysis: don't trust the media. A lot of articles are just a tool to get clicks. I maintain that the real estate news industry is as inaccurate, misleading, and full of fake news as the political news. The problem is that they're journalists. They're not in the market. There was a time when they were one of the go-to sources for great real estate information, but lately it's just become a clickbait echo chamber. Real estate news coverage is either confused or they are purposely trying to confuse you. How else do you explain their constant contradicting stories about the direction of the market? They are saying the prices are growing and expect to go up higher next year, but the next week they're announcing that prices still face a steep and sustained decline this year. Which is it? The answer is they don't care. Each week, they look for a headline, any headline, that will generate clicks on their website or drive you to watch their paid programming. Again, in the internet world, if you're not paying for the product, you are the product. And in this case, if you're reading any news, you're being misled so they can direct you to their advertisers. The topic, though, that has been the most misleading over the last few years are foreclosures and defaults. We've repeatedly seen stories about the number of mortgages that are delinquent as some sort of sign of a rise in distressed sales. But the real numbers show that the number of distressed sales remain at an all-time lows, much lower than previous periods. And inventory is low, which means that, look, if someone needs to sell their home, there's not a lot of competition. To gauge just how far off from normal today's inventory is, let's compare right now to 2019, the last, call it normal year in the market. When you compare the same week this year with the matching week in 2019, supply is about 50% lower. That means there are half the homes for sale now than there'd usually be. One of the factors contributing to the Chicken Little doomsday of the real estate market is crashing mentions that the number of delinquencies, the single family delinquency numbers, are the lowest in 25 years. Primary reasons why the housing market will not crash, and I'm predicting will increase significantly in 2024, are number one, inventory. There are less homes built in the last decade than any time in the last 50 years. A new national home builder study estimates the housing market is underbuilt by over 1.5 million homes. Number two, a lot of people have money. What else are people with money going to buy? And what other assets? And where in the world, as we talked earlier, is a safer investment than U.S. real estate? Number three, interest rates. Homeowners are not going to sell with their 2, 3, 4% rate to buy a 6, 7% home rate. Number four, there are less foreclosures now than any time in the last 25 years. Neither banks nor the government are going to let the Great Recession happen again, not in our lifetime. They've been working out forbearances for the last few years, letting homeowners modify their loans. And homeowners have unprecedented equity. Number five, institutional investors have bought hundreds of thousands of homes across the country and estimated over 40,000 here in Las Vegas. Those homes are off the market forever because they're now rental-backed securities. Look, I hope this helps clear up a lot of the misinformation out there. In coming videos, I'm going to break down, go deeper into how demographics, meaning more people and house formations, will be another factor pushing home prices higher. So be sure to subscribe and let me know any thoughts or questions in the comments below. I look forward to sharing the truth with you on the next one. Thanks.